Have you ever wondered how traders can make money when stock prices go down? That's where short selling comes into play. And it's a strategy that can be both profitable and risky. In this video, we're going to break down how short selling works, explain the process step by step, and discuss the potential risks involved. Before we dive in, it would really help out if you hit that subscribe button so you don't miss any of our future finance videos. Let's get started. What is short selling? Short selling is a trading strategy where an investor or trader borrows shares of a stock and sells them right away. The idea is to buy those shares back later when the price has dropped, allowing the investor to return the shares to the lender and keep the difference as profit. So how do traders make money? If the stock price falls, the trader buys the shares back at a lower price, returns them to the lender, and gets to pocket the difference. It's a way to profit when stock prices go down, but it comes with its own set of risks. How does short selling work? Let's walk through the process step by step to make it easy to understand. 1. Borrowing the stock. First, the trader needs to borrow shares of a stock from a broker. They don't own the shares. They're essentially taking them on loan with the agreement that they'll return them later. Brokers typically have agreements with large institutional investors, so they have shares available for borrowing. 2. Selling the borrowed stock. Once the trader has borrowed the shares, they immediately sell them at the current market price. Let's say the stock is trading at $50 a share. The trader sells the borrowed shares for $50, but remember, they still owe those shares back to the broker. 3. Waiting for the price to drop. Now, the trader plays the waiting game. The goal is to have the stock price drop. For example, if the stock's price falls from $50 to $30, the trader is in a good position. But this part can be risky because there's no guarantee the price will drop. In fact, the stock could go up, and that's where short selling can get tricky. 4. Buying back the stock. If the stock does drop in price, the trader can now buy the shares back at a cheaper price. Using our example, if the price falls to $30, the trader buys the shares back at that lower price. They initially sold the stock for $50 and now are buying it back for $30. 5. Returning the stock to the broker. Finally, the trader returns the borrowed shares to the broker. The difference between what they sold the stock for at $50 and what they paid to buy it back at $30 is their profit. In this case, $20 per share. It's a simple concept, but things can get complicated if the stock price doesn't go as planned. If the stock price rises instead of falling, the trader still has to buy the shares back, but now they're paying more for them, which could lead to a loss. This is why short selling can be risky. Let's say a trader believes that stock A is overpriced and expects its price to drop soon. At the moment, the stock is priced at $100 per share. The trader decides to short sell 10 shares of A, meaning they borrow 10 shares from their broker and sell them immediately at the current market price of $100 per share. So, that's $1,000 from selling those 10 shares, not including commission. A week later, the trader's prediction comes true, and the price of A drops to $80 per share. Now, the trader buys back the 10 shares at the lower price, spending $800, not including commission. After buying the shares, they return them to the broker, completing the short sale. In this case, the trader sold the shares for $1,000 and bought them back for $800, leaving them with a $200 profit before commission. However, if the stock price had gone up instead, the trader could have faced a loss. While short selling can offer a chance for profit, It comes with some serious risks. One major risk is the potential for unlimited losses. If the stock price goes up instead of down, there's no limit to how high it can go. This means a trader could end up buying the stock back at a much higher price than they sold it for, leading to big losses. Another risk is using margin. Short selling usually means borrowing shares from a broker, which also means borrowing money. If the trade doesn't go as planned, the trader might get a margin call, where the broker asks for more money to cover the losses. Then there's the risk of a short squeeze. A short squeeze happens when too many people are betting against a stock, but instead of the price dropping, it starts to rise. This forces traders to buy back shares to cover their positions, pushing the price even higher and making the losses worse. Because of these risks, short selling isn't for everyone and requires careful thought and planning. People short sell for a couple of main reasons. One reason is to bet against companies that they believe are overvalued or might perform poorly in the future. If a trader thinks a company's stock price is too high and will drop, short selling allows them to profit from that decline. Another reason people short sell is for hedging. Essentially, this means using short selling as a way to protect themselves from losses in other investments they hold. For example, if a trader has a lot of stocks that could be affected by a market downturn, short selling could help offset some of the risk. It acts like a kind of safety net when things aren't going well in other parts of their portfolio. To wrap things up, short selling is a strategy that allows traders to make money when stock prices go down. But it's not without its risks. The main danger is that there's no limit to how much you can lose if the price goes up instead of down. So, while it can be profitable, it requires careful consideration and understanding of the market. I'd love to hear from you. Have you ever tried short selling, or are you thinking about it? What do you think about the risks involved? Let me know your thoughts in the comments. And if you found this video helpful, don't forget to hit that like button and subscribe for more tips on finance and investing.